welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, October 28th, 2020, and I am pre-recording this Trading Places Live for Thursday, October 29th. It was a very rough day on Wednesday. Futures for Thursday currently are up pretty strongly, close to 1% across the board. So perhaps we will see some of this downside action on Wednesday reversed. Looking at the agenda for today, I'll go into your daily market recap, do talking technically. I want to take a look at the S&P 500, the NASDAQ 100, take a look at the volatility index. I think that's one of the keys we want to watch for. And then we'll get into relative strength, some of the areas I like to watch to see what is leading and lagging on a relative basis, especially when you get these big downturns like this. Kind of interesting in terms of the relative strength. So I'll go through that. Take a look at chart lists, specifically going through our key chart lists at Earnings Beats. I want to go through and look at the worst performers in each of the chart lists and just see if there's any hope for some of the stocks that were beaten up pretty good on Wednesday. Then we'll get into earnings spotlight. Couple of pretty good ones, a couple of disappointing reports as well. So we'll pull those up and take a look at them. And then we'll wrap up with three you must see. These are three material stocks that have all taken it on the chin and look to be breaking down at the end of the day. But we'll go through those and look at those individually. Before I get into any of that, I do want to point you over to earningsbeats.com. You can see here we do have a place to register for the free Earnings Beats Digest newsletter. You can subscribe simply by putting in your name, email address, hitting that subscribe button. There is no credit card required. There is no fee whatsoever, and you can unsubscribe at any time. The Digest newsletter comes out Mondays, Wednesdays, and Fridays, usually before the market opens, and deals mostly with earnings-related topics, relative strength, and so forth. The right side here, you can see our performance, and this is updated through Wednesday's close. You can see that the performance of each of our four portfolios here this quarter, all outperforming the S&P 500. And when we talk about this quarter, we have different quarters at Earnings Beats. This is dated back to August 19th. So it runs from August 19th to November 19th. And then it will run from November 19th, February 19th, February 19th, May 19th, May 19th to August 19th. We go on that cycle because that's when we select our stocks, 10 equal weighted stocks for each of our portfolios. So that's going to be coming up here in just a few weeks. But right now you can see tremendous outperformance this quarter. And the model portfolio since the beginning up 154%, almost 155%, whereas the S&P is up just 21.6% over the same period. So very good outperformance. If you want to check that out, if you'd like to go on a 30-day trial, you can click the Join Today button. And again, that 30-day trial will cover you through November 19th for the next selection process going through for all of the portfolios. All right, well, let's go and take a look at what happened. It was ugly. It was an ugly day on Wednesday. I have to admit it was, I didn't see it coming. I thought we certainly could be consolidating because we did print the high to open September. We did come down and print a low at the end of September, and we never broke back out. So we're definitely in consolidation mode, but I was really looking for our major indices to bounce off of these moving averages. Maybe on the NASDAQ, you can kind of see a cup with a handle down to the moving averages. I thought maybe we would bounce out of that, especially because today, the 28th, Wednesday, October 28th, this began a bullish period for equities historically, but you would not have known it by the action today, that's for sure. Dow Jones down 3.4%, S&P 3.5%, NASDAQ 3.7%, mid caps 2.6%, small caps 3%. It was literally across the board. All 11 sectors were down on Wednesday, led by technology, which dropped 4.25%, energy 4.18%, and communication services 3.93%. Technology getting close to that September low. Not quite there yet, but close. Communication services on its way. But look at energy. Energy breaks to a new low going back the last several months. Accumulation distribution line breaking to new lows. Energy definitely is not an area I would be looking to try to be a hero. I would stay away from that group. If you're looking for value, you're looking for, well, I shouldn't say value, but if you're looking for high reward to low risk trades, I think you can find some of those in technology. I would be watching recent support and make sure that recent support holds. And if it doesn't, exit, get right back out. I'm going to be watching some key levels, the S&P 500, 32.25 on a closing basis. But I also think after breaking out above this June high, we went back to about 3,200 here. I believe the intraday low in September was 32.09. So 3,200 to 32.25 is really important support on the S&P 500. And as I talk about in a little bit, when you get in, you start breaking down below some key price support levels with a volatility index that is extremely high, and you can be off by 1 or 2 days calling a bottom, and it can make a huge difference. When the stock market's very fearful, the losses can mount very quickly, as we saw on Wednesday with the S&P, as I said, falling 3.5% just in one day. Looking at the industry groups, renewable energy actually broke to a new high. Very strong action in renewable energy. That group was led by First Solar, which came out with strong earnings and broke to it had already broken to a multi-year high, getting through the 80 level. It was up to about 82. But with earnings, it moved up to 93 and change, a huge day there, and that helped to propel renewable energy shares higher. Recreational services, though, really beaten up. They lost the September low. Now I would be watching that beginning of August low, down at about 57 or so, 56 change, 57. We closed at 61.24, down almost 7.5%. It's been a very, very rough week for the recreational services group for sure. 10-year Treasury yield. This was a little surprising to me. We did reverse on the 10-year Treasury yield. We've got as low as 0.746, reversed back to 0.78. And when the yield reverses and goes higher, it means that Treasuries are being sold. So folks were moving back out of Treasuries today. And I would have thought that that money would have gone into stocks. But I think instead, a lot of investors simply said, we're going to sit this one out and just wait and see if we get a reversal. So I think there's money sitting on the sidelines right now. And with futures up, maybe we can start to right the ship. But definitely in the short term, the bears are in control right now. And I'll go over some key numbers here in just a minute that we'll want to be watching. As far as economic reports out on Thursday, Q3 GDP. So the initial estimate of Q3 GDP will be out in the morning. Remember, Q2, we lost 31.4% on GDP. This Q3 first estimate, we're looking for a rise of 30.9%. So looking to get a lot of that back. We'll see what happens in the morning. Initial jobless claims expected to drop again. Remember last week we were at 787,000, so we finally broke below 800,000. We're looking for that number now to drop to 758,000. So another roughly 30,000 below last week. We'll see whether or not that happens in the morning. And then at 10 a.m. tomorrow morning, September pending home sales will be out. And their forecast for a rise of 3.5%. That's the estimate. August was a rise of 8.8%, which was very hot. So it is expected to slow down, but still 3.5% rise, pretty good number. All right, talking technically. So let's talk a little bit about what's going on here with the market. This is a 35-year chart of the S&P 500 weekly. And so you can kind of see it up here. Here was the secular bear market where we went nowhere for about 12, 13 years right in here, finally broke out in 2013. I believe we're in a secular bull market, and these secular bull markets tend to last a couple of decades. I think we started it around 2013. I think we could go another 10, 11 years in this secular bull market. That doesn't mean you can't have pullbacks. We had a cyclical bear market back at the end of 2018. And this year's pandemic created a cyclical bear market where we lost 35% in about a month. So you can still have bearish periods, but they don't tend to last as long in a secular bull market. So that's what I think we're in, and that's what I think we're going to continue to see. Now, looking down below here, this panel at the bottom, this is the volatility index. And I just wanted you to look at history, because a volatility index that gets up to 45, we don't see that very often. We're at 40. 40.28 is where we closed on Wednesday. You can go back and look, and outside of the financial crisis in 2008 and outside of the pandemic back in March of this year, and probably if the VIX didn't go back to 1987, but if it had, I suspect that 1987, we would have seen a VIX probably well above 45, maybe in the 60, 80 range, something like that, very similar. Maybe because it didn't last quite as long and a lot of it was one day, maybe it wouldn't have gone up that high. But I don't believe, I don't think 45 would have held it back. I think maybe it would have broken above 45. But just look at all the other times. Throw out the 2008 financial crisis, throw out the 100-year pandemic that we had this year, and look at the last 35 years. And what you're going to find is that essentially 45 tends to cap the VIX. We rarely even get that high. But if we do, if we break into the 40s, the tendency is that the VIX tops there. And if you look at where the VIX tops, 1998 here, the market bottoms. 2001, the market bottoms. Now, it was temporary. We did end up going lower, but when we get a reading near 40 or 45, that's kind of like the market is throwing the kitchen sink in. And that's when a lot of times we'll see reversals. Here in 2002, second half 2002, we saw the VIX move through 40. And right here, we saw a short-term bottom and a move back to the upside. Then fast forward next time. And by the way, a lot of these, this other line down here is around 30. Normally, if you're getting a decent pullback, the VIX will get up to about 30 and then settle back down again as the market turns back to the upside. So this is definitely worse than your normal variety, pullback and fear level. Now, I've got a couple of thoughts on this. Number one is I kind of view these huge moves to the upside here in the VIX as almost like an earthquake. And I think after you have an earthquake, you're going to get some aftershocks. And when we saw this in 2008, you can see 2010, 2011, we had some aftershocks. Here with the pandemic, here we are now about 8 months later, and we're getting an aftershock, in my opinion, in terms of fear. Now, we already had some other pullbacks, but this is the highest the VIX has gotten since back in March. And so I think, 40, 45, this, if we turned right here, that would kind of be right about where we have turned in prior pullbacks when the market's gotten fearful. So that's just something to keep an eye on. Now, if we break above 45 and we see the S&P 500 lose 3,200, then I think we could have some issues. But for now, I'm looking at this from a bullish perspective. Some of you may be looking at it more bearishly, and that's fine. There are two sides to every market. Everybody can come up with their own thoughts and processes on how they evaluate the market and so forth. I believe we're in a secular bull market. I think the path of least resistance is to the upside, but I always respect a highly fearful market because prices can deteriorate very quickly when the VIX is elevated and rising. And so that's why I think 3,200 on the S&P is going to become very important to watch. I know futures are up right now. Who knows where they're going to be tomorrow morning when you're actually watching this recording. But if the futures turn back to the downside and all of a sudden the S&P, you find it down around that 3,200, 3,225 level and the VIX moving up through 45, be careful because the selling can escalate very quickly in a highly volatile market. So I'll be watching 3,200, 3,225, that area very closely, personally. All right, let's keep moving here. So on the S&P 500, I wanted to show you this 3,200. So after we got up here in June 8th, 3230, something like that. Let's see what that number was. 3232 was the high. We pulled back, put in a double bottom, came up here, we broke out above that 32 level. And when we came back down, this low right here was 3,200. 5 days or 4 days later, the low was 3,204. And then we had this big run until early September. We came back down, the low was 3,209. So now we got 3,200, 3,204, 3,209. We haven't broken back out above. So I want to watch these prior price support levels. We're already below the 50 and the 20-day moving average. So you don't want to lose price support as well. If we do, and that VIX is up, on the rise, I think you've got to be cautious. I think you've got to be careful. All right, NASDAQ 100. Really the same thing. I mean, I look at this and yeah, I didn't want to see the move back below the 20 and the 50-day moving average, but it happened. I think we're consolidating. This is what happens in consolidation. The moving averages tend to hold during trending markets, but in trendless markets, when you're consolidating, they don't tend to hold. And so what this tells me, what happened on Wednesday, what this tells me is that we're still consolidating. We're still consolidating this move up. We pulled back. I was thinking, okay, this is the pullback, and now back off we go to the races. Well, not so fast. It looks like now we're going to have this consolidation that we're going to have to deal with here for a period of time. Now, as far as some of the other things that I look for in the market, let's talk a little bit about relative strength. So relative strength, I've got my relative strength chart list here for industry groups, and it's weekly. So if I pull up the renewable energy space, you'll see that on a relative basis, renewable energy is just going straight through the roof. So renewable energy, another big day today to the upside. Not only did it move up on an absolute basis, obviously it crushed the market on a relative basis. So renewable energy continues to be one of the strongest, if not the strongest. I would say it's probably even stronger than the auto group at this point. But even with the pandemic, that we saw back in March, this is when the group really started to take off. And now that the virus is picking up momentum and cases are picking up again in the US and across Europe, renewable energy taking off again. So some of the same groups that were leading back in March and April and May and throughout the summer led again today. Home construction. Look at that low in March. Look at this huge move. Now it's down for the week, but today's action was higher. Remember, this is a weekly chart. So that line is going down this week, but that's because earlier in the week. It's not because of today. Today, Wednesday, we actually had a very strong day. Then you've got recreational products. Look at recreational products taking off. On the verge of another breakout on a relative basis. Still got a little work to do here on the absolute basis. But if you see this group get above 500 and breaking out on a relative basis, this remains one of the better groups in the market to trade right now, in my opinion. All right, let's see what else was on this list. How about specialty retail down here? Specialty retail been moving up. Came down just below that rising 20-week EMA, the relative 20-week EMA, but turned right back up above it. So I like that. Specialty retail having a good day on a relative basis today. One last thing to talk about here, and then I'll move on to earnings, or actually chart lists. But the one thing I wanted to mention, the consumer discretionary group, I believe, is the strongest area, is the strongest sector in the market right now. And today, with the market selling off the way it was, I found it very interesting that of these top 13 groups, right down to here with the special consumer services, of the top 13 groups, 5 of them were XLY. 5 of them were consumer discretionary industry groups. I find that interesting because if you're thinking, okay, the virus is going to take hold, things are going to slow down, wouldn't you think consumer discretionary would be hit the hardest or one among the hardest? And yet it wasn't. These consumer stocks have been very, very resilient. And I find that to be bullish. And I think that kind of goes with my bullish argument. But hey, nothing trumps a breakdown. So let's see if the S&P 500 can hold that 3,200 area. All right, moving on to earnings. I did want to pull up in the strong earnings. Eli, I'll tell you, Callaway Golf, last 2 days, this was on the verge of a breakout on Tuesday, up at 22, almost 22. 1 day later, we were as low as 1462, 1/3 of the market cap gone in a day, in a 24-hour period. Look at the volume coming in, losing a couple of key support levels. I would be staying away from ELY. In our short squeeze chart list, the worst performer was Bed Bath & Beyond. This has been a great performer of late, but the volume picked up. We went below the 20. I would be watching now key gap support just above $18. The strong future chart list, strong future earnings chart list, CDE. So mining company, pulling back, watch that 650, 660 area. That's been, that was support on that reversing candle. We saw a piercing candle in the third, fourth week of September. Nice rally off of it. Well, we're almost back down there again. A break below 650 would be bearish. On our strong AD chart list, strong accumulation distribution chart list, LBRT was the worst performer, down almost 15%. This had a huge gap up beginning of September, and it gapped up from this close of 645. Today's close was 665. We could be going down and filling that gap at 645. We go below 645 and come back up and close above it. That could fill the gap and set a bottom. But this is in the energy space, and energy has not been very strong, so I would be a little skeptical there. Next up, on our week AD chart list, a lot of the cruise lines are on that chart list, and here's one, Carnival Corp taking a big hit, more than 10%, and look at the breakdown. Lowest level, lowest close we've seen now since the second week of May. So Carnival Cruise Line's not looking very good. And then the raised guidance chart list, we'll go first with Akamai. There were two of them that were battling for worst performer. Akamai, now a couple things that I'll point out, and I think this is really important from a short-term trading perspective. So if you look, there was your low back in September. Here was a test of that low. You see this low going a little bit lower than those and then reversing? Nice little hammer with a lower low. A lot of times that's what you get before a short-term move back to the upside. Now here, Akamai went up, hit that 20-day moving average. Now remember I said during consolidation, we see lots of movement above and below moving averages. But when you're trending, you tend to struggle either to get through if you're beneath, or you tend to hold if you're above. Look at what Akamai did here. Came off of the support, went right up to the 20-day and failed and broke back down again on heavy volume. So not a very good looking chart. Next one I'm going to give you, Dexcom, is another. Let me pull Dexcom up. This is in the medical supplies group. But after earnings, you can see the big breakdown here. But going back to this low, beginning of June, right around 340, we went below it and then recovered. I could see Dexcom getting a little bit of a pop back up near 380, maybe even a little bit above that. If it does, watch that 20-day, because if the 20-day fails, just like we were looking at on Akamai, if we fail at the 20-day and come back down and close below that 340 level, that would be very bearish. But if we can get back up through the 20-day, obviously that would speak more toward sideways consolidation. So that'll be a stock to watch for sure. All right, earnings spotlight. I want to get into a few of these companies here, and then we'll wrap up with the three you must see. One that I wanted to show you was Pinterest. Pinterest is up 31% after hours. They came in, they blew away bottom line. They were only expected to earn a penny. They came in at 13 cents. Market seemed to love that. They beat on the top line. And the stock, last time I looked, was trading up at about $63, $64 a share from 49. So we are going to have a pretty good day on Pinterest. This is a stock in our model portfolio, so that'll certainly help our model portfolio tomorrow. But we've got other stocks that certainly are not performing very well, and a couple of them in our portfolios. If you remember, Fastly came out and warned that their revenues were going to fall short. Well, they reported their everything today, and they came in below expectations on earnings. They came in with a 4-cent loss. The market was only expecting a 1-cent loss. There haven't been too many companies that have missed, but we saw Fastly go right down to that low of September, just above 70. And after hours, even with the bad news, the stock was up a little more than 1%, maybe 1.5%. So we'll see whether or not Fastly can improve tomorrow. Any kind of a move back up, though, you got to watch those moving averages. Stock under pressure with heavy volume these past couple weeks. Let's see, what else did we have? Another portfolio stock at earnings beats, not being treated very kindly after hours, is Genmark Diagnostics. Genmark, back in August, had actually pulled back, was looking pretty good near this gap support, but since then, it's been trading down, tried to rally back. Now it's been going lower again. After hours, the stock was trading down, I believe, below $11. So we're going to want to watch this double bottom here. If we fail to hold that, next low is going to be down around $9. All right, what else came in after hours? How about Ford? Ford reported a good number. 65 cents on the bottom line. Market was only expecting 22 cents. Ford was up almost 5% after hours. So, and it has broken out, it's trending up, holding that 20-day, bouncing off of it, or at least looks to maybe bounce off of it. Let's see if we can get a close up above about 830, 835. That would be bullish on Ford. KLA 10 Core in the semi space reported. They were flat after hours last time I looked, but KLA did beat $3.03 versus $2.75. Thought looked pretty good. One company in the software area that's been a really good performer, ServiceNow, ticker symbol NOW, beat 121 versus 103. So $1.21 bottom line. Market expecting 103. Stock was up about 2% in after hours, but it needs to hold this trend line. So a little bit of a pop, but not a breakout. So we'll see whether or not we can hold that 50-day moving average. All right. Maybe do one more here. Livongo, LVGO. This, of course, has been one of the high flyers. Trying to get that breakout above 150. It is not going to come with earnings, at least not based on what I was seeing after hours. They did beat 16 cents versus 4 cents, but the stock was down 4% after hours. All right, let's wrap it up with the 3 you must see. I'm going to start off with, let's see. These are all going to be in the materials area. Let's start with KGC. This is Kinross Gold. Big breakdown here. Notice the double top, and then you've got support coming down here at about $8. We broke through it, lost 10.6%, pretty good volume. I do not like this chart at all, the way it broke down. I would be watching the declining 20-day EMA as your key resistance going forward. WPM, this is Wheaton Precious Metals. Similar deal. We didn't quite get the double top, but definitely, you know, we had some support around the 47, 47.5 area. We lost that by a mile, closing at 44.34, volume picking up. It certainly looks like more weakness ahead for WPM. Again, I would watch that declining 20-day EMA. That would be a key resistance area. And then finally, the last stock I have is AGI, Alamos Gold. Another breakdown. This one has been trending lower. Certainly seems to me like this breakout area, which is around $7, $7.25. I wouldn't be surprised to see that challenged. So watch that falling 20-day EMA there as well. All right, that is it for me today. I want to wish everyone a great weekend. I'll be back at Earnings Beats next Monday for your next Trading Places Live. Until then, watch that VIX, watch the S&P 500 at 3,200. Let's see if we can build some support and start moving higher. If we don't, could have some more weakness ahead. Everybody have a great weekend. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.